What is going on with these markets? Up 4% on Monday. Is everybody just convinced that the markets are going to come roaring right back no matter how bad the news is? Well, we're going to talk about that and much more starting now. Hey everybody, Tom Gentile. Welcome to Tom's Trading Room. As we approach Memorial Day weekend, I want to talk about fear of missing out. So, there's a lot of different stories out there right now. Who's on the long side, who's on the short side. But I want to show you some areas that I believe retail traders have gotten a little bit too much jumping on the latest move in the markets. So it's really easy to look at charts and feel like you're missing the boat as the market appears to be making a quick recovery. But is it? And more importantly, is the easy money to the upside now gone? All right, so I want to look at multiple charts, and you can decide for yourself what you believe is going to happen, as well as what I believe is the best course of action going forward. So first of all, I'm looking at the Bloomberg terminal, and the first chart I want to show you is the PE ratio of the S&P 500. Now, this goes all the way back to 2001, before 9/11. And as we come into 9/11, and then out of 9/11, we saw PE ratios fall to 16 to as far as 14 before starting a recovery. Then we started to make a move down, and we hit a low, guess where? At the bottom of the financial crisis, when PE ratios, that's the price to earnings ratio of stocks in the S&P 500, fell to historic levels. This is a value play down here. Now, from 2008 all the way up to around 2018, we ran from PE ratios of 10 up to 18, had fallen back in 2019 to recover in 2020. Now, right here is the all-time highs with the S&P 500. At the same time, we were getting some new recent highs with PE ratios. COVID-19 saw PEs fall, but then the markets reacted, and we're now trading up here at historically high levels. Why is that? I'll tell you why. Because as fundamentals have been dropping across companies in the S&P 500, traders have been putting their money into stocks with the S&P 500, causing this PE multiple to actually go higher. And even though we haven't hit new highs yet in the S&P 500, the fact that multiples are high are telling us that there's a widening between companies having less and less earnings. And even stocks, if they stay where they are right now, if companies continue to drop their earnings off, it's going to cause the PE multiple to go higher. All right? Bad news for the future. Next chart I want to show you is something I call uptick. Uptick is the number of ticks going up, prices going up versus down ticks. And this is a lot of noise you see here. And this moves back and forth quite a bit. But I want to show you a couple of areas here. We saw some contraction between up and down ticks back in the area of around 2006, all right? But we've never seen it get this wide, all right, where you see it up here just recently and also down at the bottom. We were near minus 2,000 ticks at the bottom of the coronavirus pandemic on March 23rd, but we went up just as quick on Monday. And on Monday, we hit 2,000 upticks versus down ticks. Again, a number that's telling us that there's a lot of traders that are jumping in on the long side, especially on Monday when we had that 4% up day. Next chart I want to show you. This is for option traders. Okay, so put-call ratio, something I don't follow every day, but I want to share with you what's happened this year. The blue line represents the S&P 500. This area right here is the all-time high. We dropped down to the lows on March 23rd. Put-call ratio, which is typically gives us an idea of puts to calls, was very, very low when we hit the all-time high. This basically means there were more calls being bought than puts, all right? That spiked as the market dropped. But look where we are now. As the S&P has recovered, more and more call traders to put traders are trading on the call side. Again, and I saw another chart that showed that a lot of retail traders are buying calls and selling puts. Again, a bad sign because usually the retail trader is on the wrong end of the trend on both sides of the market. Now let's take a look at some of the charts I pulled from TomsOptionTools.com. First one you see here is what's called price to IV divergence. As the price of the S&P has gone up, what's interesting is that although the implied volatility has gone down, it seems to have bottomed. And so we've got some divergence here from option traders keeping that IV level from making new lows, while stock traders are continuing to push the markets higher. Do the option traders know something? Well, only time will tell. Next chart I want to show you is channel resistance. We are coming upon some really good channel resistance right up here around the 295 to 300 mark on SPY. All right, very big resistance there, and not only resistance with what we call stock chart peaks. There's round number resistance at 300, but we're getting a lot of channel resistance between long, intermediate, and short-term channels. All right, finally, a channel or a chart I want to call hitting the big 62. The big 62 is really the 61.8% retracement level when you're looking at Fibonacci ratios. The Fibonacci highs were at the all-time highs of the markets. Fibonacci low came down to 222 on the S&P on March 23rd. We have retraced. We've retraced to the 31%, ran through it. We retraced to the 50%, ran through it. We've hit the 62% or 61.8% area once, twice, 3 times. All right, where do we go from there? The market's got to give. Either we're going to get a blast to the upside or we're going to get some sort of a pullback. And again, only time will tell. But when I put all of these charts together, they tell me the same thing. What they tell me is that there's a lot of upticks coming with lower and lower volume. Right? That's typically a sign that the retail investor is getting in because they are fearing or fearful of missing out on what they believe is the recovery coming. All right. So now let's talk about how to trade this if you believe the markets are due for another move to the downside. So what I want to look at here is 3 ways to trade this. Number 1, we could short the stock. Shorting the stock means that if you have a stock price, let's call it at 100, if the stock price goes down in value, your profit potential goes up all the way to 0. The problem with stock positions are if they run against you, if you short a stock, it goes higher, you could actually lose money. So what is shorting stocks? Shorting stocks are taking a bearish position. All right, to open a short position, you basically are borrowing the stock from someone else, all right, typically your broker, to sell on the market. And then your job when it comes time to close that position out is to buy it back and then give the stock back to whoever you borrowed it from. So imagine this. If you borrowed a stock and you sell it at 100 and then you buy it back at 50 and you give it back, you keep the $50 in between. All right? It's called selling high and buying low. It's something a lot of people just simply don't think about doing. But even if you did, it comes with risk. Again, if we took 100 shares of SPY, for instance, trading at around the 294.33 level, right? The cost to do this, there is a margin associated with it, and it would probably be somewhere between $6,000 and $30,000 to short 100 shares of stock, all right? Your risk is unlimited because if the stock goes higher, your position goes lower, and we don't know where high is in any stock, but we do know where low is. Low is 0, and your reward is limited. It's a big reward, but it is limited to the price of any stock or ETF falling to 0. All right? Now, second way to trade this. If you're bearish, buy put options. A put option allows you to have the right to sell SPY or whatever stock you're interested in at a specified price for a specified amount of time. So what happens is as a put option goes lower, or as the stock goes lower, your put option actually goes up in value. If the stock were to go higher, you have a fixed amount of risk between break even and wherever your loss may be. All right? So again, buying puts are bearish. To open a put position, you simply buy to open the put option, and you're looking at expiration, strike, and premium. And to close it, you simply reverse that order. You sell to close and pocket potentially some profits, but you will pocket credit if a credit is there. All right, now let's take a look at an example using SPY. Now, if I were really going out longer term, perhaps I'm looking at maybe the October 2020 puts. The 295 puts right now are trading for $20.80. That means my cost and risk on this trade is $2,080. How do I come up with that? You take the $20.80 and you multiply that times 100, and that's the cost of one contract to short the S&P at 295. But you have between now and October 16th to take advantage of this position. Reward is limited but high because you remember your reward is all the way to zero. Your risk, though, is actually limited to the amount you pay for the put. Now, to get to break even, which, by the way, break even on this example is 274.20. So the market, even though it's trading around just below 295, has to get to 274.20 by October 16th for you to break even on the trade. Break even is determined by looking at the strike price, that's your 295 puts, minus the premium, $20.80, and that's where you come up with 274.20. All right? Last way to trade this would be with what I like to call a bear put spread. Limited risk, limited reward, better looking break even when you compare it to buying a put outright. And again, some ideas on this. Buying put spreads are also bearish. To open a bear spread, what you do is you buy to open the higher strike put, you sell to open the lower strike put, and that costs you money, but much less than if you were just simply buying a put option on its own. To sell the position, you simply reverse the order for a credit. Here's an example, again, using SPY. So instead of buying the 295 puts, like the earlier example, what if I bought the 295 puts and then I financed part of that cost by selling the 280 puts? So if I take in 1580, helps offset the 2080 that I have, and now my trade costs $500. I determine that by taking the strike that I bought minus, so this is $20.80 minus $15.80, which gives me a cost of 5 points. All right, 5 points times 100, $500. Cost and risk, $500. Reward is $1,000. How do I get to that reward? Simply put, you do it this way. You take the difference between strikes. That's 15. 15 minus 5 is 10. 10 times 100, which is 100 shares for the contract, gives you a maximum reward of $1,000. This is a 200% reward to risk ratio because you have the ability to make up to twice as much as you risk on the trade. To get the break even is very simple. You take the buy strike, that's the 295 put, take away what it cost you to do for the trade, $5, and your downside break even is 290. So, good, better, or best? I got 3 examples here for you. Obviously, shorting the stock does have the best break even, but costs the most and has the most risk. Buying a put option gives you a better situation in terms of cost and risk than shorting the stock, but it too has a price to pay. In this case, it was over $20. And finally, the bear put spread. It cost the least, it had a better break even than buying the put itself, and it also had a better return on risk when you were targeting a low price, say 290, 280 on the S&P 500. All right. Hey guys, thanks for joining me. And again, if you like this video, give me a thumbs up. And also, if you want to receive the videos from me on a timely basis, be sure to hit the bell. You'll be notified once I upload them. Thanks again. I'll see you on the next one.